coming up on Retiring Well with Michael Reese.
And if you compare these two numbers, that's a reduction of a little over 20%. So their tax liability has been reduced by about 20%. So you've got this huge opportunity to do Roth conversions at discounted rates.
Mike, the biggest one that comes to mind at first is the fact that everybody got a break.
Yeah.
Everybody from the top to the bottom got a tax reduction.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and as you can see, I've got a special guest with us this week, and that, of course, is Larry Flynn. Larry, thanks for being here.
You bet. Thank you.
Now, Larry is one of the financial advisors at Centennial Wealth Advisory. He's also an expert when it comes to tax planning, and as you know, we have a new tax law. And of course, it's effective January 1, 2018. It's our job to help you understand what the heck's going on out there financially speaking. So I brought Larry in to help us better understand this new tax law. And it's a big deal, right?
It's a big deal.
Okay, so there's a lot of different things here that have changed. At least that's what Larry told me. And he's got a list of some of the more important ones. So Larry, why don't you go ahead? Let's go through that list, and then we can jump back and kind of talk about the ones that are probably more important.
You got it, Mike. Well, first of all, the big one is everybody got basically a 3% reduction in their tax rates, okay? They got double the standard deduction than they had before. They actually doubled the estate tax exemption.
Doubled the estate tax.
Went from $5.5 million to $11 million. We can still deduct medical expenses when we itemize. We can still deduct our mortgage interest when we itemize. We can still deduct charitable contributions. And education credits still remain. Okay? Some other interesting things are alimony is no longer deductible. Not good for divorcees, right? No personal exemptions are allowed now. So where they got a double standard deduction, but we lose the personal exemptions. There's no health care mandate. Okay? No penalty for not having health care. There's no longer a recharacterization of Roth IRAs, which we should probably talk a little bit more about. State and local taxes are capped. You can only deduct the first $10,000. And what's interesting is that there is no change in how Social Security is taxed.
Okay, wow, that's quite a list already. That's a lot of things there. So I think I'll just go ahead and estate taxes are what? What'd you say? $5.5 million to $11 million?
$11 million.
Does that mean for a married couple they can now have $22 million?
Exactly.
We know. All right, folks. If that's you, if you're out there with $22 million of net worth and you don't have any estate taxes anymore, I guess there's a couple of us that could be adopted.
Yeah,
but anyway, no. So let's go ahead. So you said that the tax there's a 3%, 2 or 3% reduction of tax in the tax brackets.
That's
right. So what does that mean? Help me better understand what that is.
Well, where those that were in maybe the 15% bracket, or that bracket is now 12%.
Okay, so they're not paying so much any. Now, did the bracket numbers stay the same, or did those get changed as well?
Expanded as well. Yeah,
all right.
So it's a little bit different. But for all practical purposes, if you were in a 15% tax bracket, you're now only in the 12. So
and then what were you saying to me too? Weren't you saying something about there's that 24, it goes what, 12, there's 24, and 24 goes all the way to like 300,000 or something?
That's right. Where somebody used to be in the 33% bracket, they're now in the 24% bracket.
Okay, so that sounds like, if you're out there, you're making, that's kind of interesting, because if you can get up to 300,000 and still be in the 24% bracket, that might open the door to some Roth conversions or something, right?
Yep.
But what does that mean when you said something about Roth, recharacterization, talking about Roth? What did that mean?
Well, you used to be able to convert an IRA to a Roth, right? Pay the tax on it now, get it into a Roth, growing tax deferred, tax free down the road, right?
Okay.
But you used to have the ability, if you did that in a calendar year and then decided that it was not a good thing, like maybe the value of that account went down, you go, oops, I paid tax on it a higher rate.
Oops, I messed up.
By the end of the extension period being October, you could change that back. You could recharacterize it.
Okay, so basically what you're saying is, if I took an IRA, so folks, now pay attention, if I took an IRA and I made it a Roth IRA, you're saying that in the past I could change my mind for whatever reason.
Yep.
Can't do that anymore.
No.
Right? Can't do that anymore.
No.
All right. No alimony I saw. What was some of the other things in there? What was it? Social Security's the same, and then if people itemize, there's still like medical expenses they could itemize along with some other things, right?
Right. Still take charity, still take medical. For 2 years, it's going to be back to 7.5% of your adjusted gross income.
Then they bump it up.
Those go
But
back to
nevertheless, that's if they itemize, but standard deductions are going up.
That's right.
Right? So there's a lot going on here. And folks, we're going to spend the show today talking about some of this, exploring some of these areas to see where we can help you. So don't go anywhere. Run out of time here in this segment. We'll be right back.
The new Trump tax code opens the window to potentially saving thousands on your IRA. Learn how to take advantage of the new law at a dinner evening with your Retiring Well TV hosts from Centennial Wealth Advisory. This is a no-cost, information-only, no-pressure event with a fine dining experience you won't soon forget. Important topics we'll discuss are 3 ways to use the new tax code to move money into tax-free accounts at reduced rates. Hidden tax-related pitfalls that most advisors are missing, the importance of managing risk, and the effect of volatility on your retirement savings. The #1 mistake most Americans are making with their retirement accounts. Are you one of them? And much more. Dinner is on us, and there is absolutely no obligation. Call 888-608-5825 to register and choose the date and location that is most convenient for you. Thursday, April 26th, at the Boone's Long Lake Inn in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. Don't miss this important presentation and learn how the new tax code opens the window to potentially saving thousands. Call 888-608-5825 today.
Hi, I'm sitting here with Larry Flynn. Thanks for being here, Larry.
Thank you, Mike.
He's one of the advisors at Centennial Wealth Advisory. And folks, as you may know by now, we certainly invite you to come visit with us. It's absolutely free to get a second opinion on your retirement planning. And I think it's important to get a second opinion from someone who's a specialist when it comes to retirement planning. And Larry, I'm sure they're wondering, if they pick up the phone and they call and come visit with you, what can they expect? What's that experience like?
Well, Mike, they can expect not to get hard sold, okay? We're going to greet them warmly. We're going to sit down and talk to them a little bit about maybe their story, where they're from, where they grew up, how they met their spouse, what they're dreaming of doing once they get soon to be retired or retired.
Kind of what are their goals, right?
Yeah, what are your goals? We're going to talk to them a little bit about who we are, what we do, show them how we do things, especially dealing in the market realities we find ourselves in today.
Got it. So essentially, they're coming in, you're learning a little bit about what's important to them, what their goals are, what they're trying to accomplish. I'm sure you're taking a look at what they're doing so far. You maybe share a little bit about you, and it's just in a very relaxed atmosphere.
That's right.
And there's no cost to do this. Is that correct?
No cost. No
All right. So, folks, there you go. I mean, it sounds very simple, very easy, very laid back. There's no reason for you not to just pick up the phone, call the number on the screen, come visit us, get that second opinion. You'd be glad that you did. Welcome to this week's Chalk Talk. As you know, we're talking about the new tax bill and how it affects all of us. And what I did is I had Larry run some different scenarios for us to see how the new tax law would compare to what we had before. So in other words, he tried to keep it simple. He took married couples, so just different income levels. That's it. So what we have here is we have a married couple with $80,000 adjusted gross income. We have another at $140,000, and then a third at $220,000. And the idea here is to see, what would they have owed under the 2017 tax bill, or tax law, if you will, versus what they're going to owe in the new Trump tax law, the 2018 tax bill. So why don't we go ahead and start with our one at the top, the 80,000 AGI, and we'll go on down. So let's take a look at these folks right here. At 80,000 of adjusted gross income, in 2017, they would have owed about $7,600, $7,576. Now, that's not state income tax, it's just at the federal level. So that's just, we're talking, what's owed to Washington, D.C. So about $7,600. Now, if you compare that to their overall income of 80,000, that's about 9.5%, something like that. So a little less than 10% effective tax rate. With the 2018 tax bill, however, their taxes go down from $7,600 down to roughly $6,000. They get a, what is that, $1,500 to $1,600 reduction of their tax liability. That's $1,500 in their pocket. Now, if you look at on 80,000, now they're down to about 7.5% tax bracket. That's pretty good. And if you compare these two numbers, that's a reduction of a little over 20%. So their tax liability has been reduced by about 20%. Well, as you know, if you watch the media or read the media, we know clearly this new tax bill benefits the rich, not the poor. So let's move up the income ladder here and let's see if that's true or not. So here we go. Now we've got a couple, and they're 140,000 of AGI. And again, under the 2017 tax bill or tax code, they would have owed about $20,000, $20,650. Now, I don't know about you, but imagine you have to write that check to the IRS every year, a check for $20,000 to the IRS. You might sit there and say, yeah, they're making 140. That's still a pretty big number, right? Well, with the new tax bill, they're down to $16,800, which is still a big number. But it is a reduction of, what is that, $3,800? Well, certainly they're benefiting more than the couple up here, aren't they? They're getting $3,800 back. They're only getting $1,500 back. So that's we could say they're benefiting more, but if you look at the percentage, they're only getting 18% reduction, whereas these guys were getting over 20. So on a percentage basis, they're actually getting less of a benefit. Well, let's go down 220, because again, the rich are supposed to benefit here, right? 220, we're starting to get richer, as it were. In 2017, look at this number. $42,000 are given to the IRS. Holy cow, that's getting up there. 2018, it's still $35,000, which is still a ridiculous number in my opinion. That's just a lot of money. But here's the thing. Again, a reduction of about $7,000. Again, they're benefiting dollar-wise more than either of these two levels. But if you look at the difference, it's really a difference of about 16%. So as we're going up the ladder, people that make more income, dollar-wise are getting a bigger benefit. However, percentage-wise, it's a smaller benefit. Either way, though, I'm looking at this, I'm saying if you're about 80,000 AGI, effectively you're paying about 7.5% tax. If you're at 140, you're paying about 12% tax. If you're at 220, now we're paying, what is that, about 13, 14% tax. In other words, the more you make, the bigger percentage of your income you pay in tax. That's still the case. But based on what we're seeing here, if you pay tax at all, odds are with this new tax bill, you're going to pay less. And less is always good, in our opinion.
The new Trump tax code opens the window to potentially saving thousands on your IRA. Learn how to take advantage of the new law at a dinner evening with your Retiring Well TV hosts from Centennial Wealth Advisory. This is a no-cost, information-only, no-pressure event with a fine dining experience you won't soon forget. Important topics we'll discuss are 3 ways to use the new tax code to move money into tax-free accounts at reduced rates, hidden tax-related pitfalls that most advisors are missing, the importance of managing risk, and the effect of volatility on your retirement savings. The number one mistake most Americans are making with their retirement accounts. Are you one of them? And much more. Dinner is on us, and there is absolutely no obligation. Call 888-608-5825 to register and choose the date and location that is most convenient for you. Thursday, April 26th at the Boone's Long Lake Inn in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. Don't miss this important presentation and learn how the new tax code opens the window to potentially saving thousands. Call 888-608-5825 today.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Welcome back. So as you know, we're talking about the new tax code this week, and we just got done on Chalk Talk looking at how different tax brackets, how people at different income levels are affected, all in a positive way. And now what I've got Larry here to talk about right now is you had brought to my attention that now with this big 24% bracket, that we've got some really neat Roth conversion opportunities. So how about you go ahead and share with everyone, kind of what you were telling me.
Okay. Well, Mike, I just took an atypical married couple in retirement at the top with Social Security pension and IRA money, right, at the top of the 15% bracket.
So basically they were making enough. We have this a lot in our office, by the way, where these folks, the way that they were structured with their income, they were pretty much at the top of the 15% bracket in 2017 and before. Right?
For all tax planning purposes, that's what we were trying to do, is keep them there. Right?
Yeah, and if they try to do a Roth conversion from that point, they are immediately in the 25% bracket and above, right?
That's right.
Okay.
Right. So we took this couple and said, all right, what's it look like if we were to convert $200,000? What would the tax ramifications be of that, right?
Okay, so what would it cost them if they converted in 2017?
Right.
$200,000 of IRA to Roth IRA.
Right.
What'd you learn?
The tax that they would have paid would have been on all their income would have been $66,000, including that Roth conversion.
So $66,000 in total tax would be on their income and Roth conversion. How much of that is attributable to the Roth conversion?
About $56,000.
Oh, wow, most of it, right? So let's just take a quick breath here. So our starting point here is we have this couple at the top of the 15% bracket. If they had wanted to convert, $200,000
That's right.
in 2017, it would have cost them about $56,000 in additional tax.
Right.
Which, what is that, like a 28?
28%.
Yeah, so about 28%. So, does it make sense to convert at 28%? Probably not. I mean, that's kind of a high price to pay. Right?
Especially when they were pulling money out of the IRA only at 15%.
Yeah. Right? So then what did we learn and then what you did is you looked at what would those numbers look like had it been 2018, they were doing the same thing. Right?
So same income.
New
right?
tax code.
New tax code, same income.
Same everything.
Converting 200,000, right, same everything. All right, their tax went, under the new tax law change, it went down to almost $54,000.
So a reduction of,
About
$12,000?
Yes.
So that's like 6% on the 200,000. So like the total cost to convert instead of 28% is now what?
23%.
22, 23?
Yep, about 23%.
So basically what you're saying is, so here's what we're learning. If they were to convert money under the new tax code, in this example, they could convert 200K at 23% versus 28% before.
That's right.
So that's about a 20% savings in conversion cost, right?
That's right.
I mean, now think about that for a minute. You got like a 20% off sale on converting IRA money to Roth IRA money. That's essentially what we're saying. Now, but it's the tax code, Larry. I'm sure that the numbers will be identical for everyone, right?
Oh, yeah, right.
No, that's right. No, I mean, that's what's gonna happen. Here's the problem. I know in this case, you're just trying to run some numbers and just get a feel for, will that new tax code provide some benefit potentially with Roth conversions? Right.
And you're right, Mike. I mean, what is the answer? It really comes down to doing the analysis. At least there's an opportunity here. It's time to talk to the advisor and say, hey, let's talk about this opportunity. How's that look for me?
Right, because everyone's different.
That's right.
So what Larry's telling us, and just so that I can kind of feed this back to you, what Larry's telling you is, he's saying, look, we have, and correct me if I'm wrong, we have a tremendous opportunity right now.
Yeah, for 8 years.
But it's only for 8 years, because this thing ends in 2026. So you've got this huge opportunity to do Roth conversions at discounted rates. Does it make sense for you or not? Who knows? That's why you need to pick up the phone and call us so we can sit down and help you evaluate it.
The new Trump tax code opens the window to potentially saving thousands on your IRA. Learn how to take advantage of the new law at a dinner evening with your Retiring Well TV hosts from Centennial Wealth Advisory. This is a no-cost, information-only, no-pressure event with a fine dining experience you won't soon forget. Important topics we'll discuss are 3 ways to use the new tax code to move money into tax-free accounts at reduced rates, hidden tax-related pitfalls that most advisors are missing, the importance of managing risk and the effect of volatility on your retirement savings, the #1 mistake most Americans are making with their retirement accounts. Are you one of them? And much more. Dinner is on us, and there is absolutely no obligation. Call 888-608-5825 to register and choose the date and location that is most convenient for you. Thursday, April 26th at the Boone's Long Lake Inn in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. Don't miss this important presentation and learn how the new tax code opens the window to potentially saving thousands. Call 888-608-5825 today.
Do you have a plan for how to generate income during retirement? Are you going to run out of money? In today's marketplace, retirees have concerns about the volatility of the market. People have concerns that the traditional balanced portfolio strategy that advisors used in the 80s and 90s isn't good enough in today's new normal economy. There are more secure options available for you today, and that's what we specialize in here at Centennial Wealth Advisory. If you don't yet have a plan or would like a second opinion on your retirement income plan, please call us today for a free, no obligation, complete retirement review.
All right, welcome back, folks. As we reach the last segment of the show, Larry, we've covered a lot of ground today, haven't we?
Yes, we have.
And I know what's happening. I know you're out there watching us, and they're probably out there thinking, Larry, my gosh, taxes aren't fun to begin with. It's complicated. It's ridiculously hard. Kind of a dry subject, and I'm sure that it would be helpful if we could give them, a few takeaways. So, as you think about the things we talked about on the show, Larry, what might be, there's probably 2-3 things they could take away. What might be one of them that comes to mind first?
Mike, the biggest one that comes to mind at first is the fact that everybody got a break.
Yeah.
Everybody from the top to the bottom got a tax reduction, basically.
That's always good news. I mean, hey, sending less money to Washington never hurt.
That's right. Now, despite what you hear on the news, that the case was really everybody got a tax reduction. Anybody that was in the 39% brackets, 36. Those that were in the 25 or 22. Those that are in the 15 are now 12.
Yeah, so 3% pretty much across the board. Yeah. What about, and then isn't it true that the other kind of neat thing that we saw with those tax reductions or reducing the tax rates was that this, for the middle class, I mean, you've got this 24% bracket now. What's it go to, like 315,000 or something like that?
Yes.
So it's like you can make up to 300. Before that was 33% for a married couple. I mean, I know the single rates are different, but that's a big big field, isn't it?
Yep, that's a big deal. It's a great opportunity for what is Roth conversions, right?
Okay, so we've got tax rates going down would be one takeaway. And then you were just saying something about Roth conversions is maybe another takeaway. Right. So I know we talked about that earlier on the show, but let's expand on that a little bit.
Well, let's think about it, Mike. When we put into a lot of qualified plans, IRAs and 401ks, we're in our working years, right? We were typically in higher tax rates, right?
Right.
All of a sudden now, with a reduction in tax rates, there's an opportunity to get that money out of those plans at a lot lower cost, right? Which would have been the concept from the beginning.
Yeah, well, that's true, because I know the old adage is, when you put money into your 401k, the idea being, hey, let's save money today or save tax today because we're in this really high tax bracket. And hopefully when we retire, we're in a lower tax bracket. Now, the problem that we've seen recently, of course, is that a lot of our clients who are retired, they're saying, wait a minute, what happened to my lower tax bracket when I retire? They weren't seeing it.
That's right.
Maybe now they will start to see that a little bit.
Right. And most importantly, Mike, that most people have to understand is this tax law is only good for the next 8 years.
Okay, so for Roth conversions, this concept of moving money from IRA to Roth, so folks, it's going from IRA, highly taxable asset, to Roth IRA, which is tax-free. That concept is now making a lot of sense, you're saying, but you're saying it's like a window of opportunity that's not forever.
Right. Now, they could always extend it, like they did all those credits that we had back, right? Every year, Congress would just extend it one more year. They could always do that. But let's assume they don't, and rates just go back to where they were, right? This is 8 years of maybe an opportunity that we might not have again.
Wow. Now, to me, that's a real biggie. So as you're sitting there at home watching, I mean, you've got, what Larry's saying is, you can't just sit back and kind of get to it when you get to it. There are some opportunities out here. You've got to take action now and really take advantage of them. Is that a fair statement?
That's right.
Okay, so we've got rates are lower for everyone. We've got windows of opportunities for Roth conversions. Is there maybe like a third takeaway that you might have?
Probably the third biggest one would be they doubled the standard deduction for everybody. So where for a married couple it was $12,000, it's now $24,000.
And given that most of our clients are retired, that's a big deal. Would you say most of our clients take the standard, or do they itemize?
Yeah, most would take the standard deduction because they hopefully have their homes paid for by now, right? So they don't have the mortgage interest deduction. So many weren't able to itemize anyway. So this deduction for them is huge.
Okay, so what you're saying is now with this double standard deduction, then, it simplifies things. They don't have to even try to itemize anymore. They don't have to play these games about doing property taxes every other year and all that crazy stuff. So it makes life a little easier.
That's right.
So, folks, I mean, it sounds like what I'm hearing, lower rates across the board, Roth conversion opportunities, and simplification on the standard deduction side.
Yep.
Man, that sounds great. Folks, look, I hope you got a lot of our show this week. That's about all the time we have. So I hope you have a great weekend. Thanks for watching.